Welcome to the PwC Business Success Podcast. Today we're going to delve deep and come up with bold ideas and smart strategies towards business growth. Growth brings complexity, and therefore I've got two specialists in the room with us, Robert Beighton, a partner at PwC and in the lead of the deal strategy team, and a senior manager that works in Rob's team, Muhsinah. Welcome.
Thanks very much, Frances. Yeah, very, very happy to be here, and looking forward to the conversation today.
Yeah, thank you. I'm very excited to join the conversation.
So let's look at the big picture first. In today's disruptive landscape, there's you need to come up with, like I said, bold strategies, and if you don't evolve as a business, the business will stagnate. What they say, what doesn't grow will decline. So, Rob, what is your take on that? You can either grow through acquisition, or you can grow organically and cope with all the different challenges that come with growth. What would your advice be?
Yeah, so Frances, when we're thinking about growth, you can kind of break it down into two things. There's either organic growth or inorganic growth. So, as far as organic growth is concerned, this is where you are continuing with your business as is, maximizing your sales channels, maximizing your product potential, looking for pricing efficiencies in the market, and doing all sorts of potential business model or operating model tweaks that are continue to drive the business forwards as it currently stands. And organic growth, depending on what stage of your company maturity or life cycle you're in, could be high double-digit growth, or it could be solid single-digit growth. And that gives you the opportunity when your business is in that kind of flow state, to maximize efficiencies within the organization. The other side of the growth strategy equation is the inorganic growth, which is around mostly acquisitions. And this is a real opportunity to step change your business in terms of taking it to another level, depending on exactly what it is that you're trying to achieve. So if it's primarily growth from a revenue perspective, you can very rapidly gain market share by doing that. Equally, it might be growth in terms of acquiring new product sets or capabilities, moving into new customer segments, or even entering new geographies. But I think the most important thing that underpins the decision to either follow an organic or inorganic growth strategy is to be very, very clear on exactly what is it that you're trying to achieve with that strategy. That's the underpin that sits behind that as a starting point.
Yeah, and I agree. Acquisition isn't just about buying another company. It's about accelerating success, but not without risk. Poorly executed acquisitions can destabilize operations and really disrupt culture. That's why strategic alignment is critical.
So, on to that point, what should leaders look out for?
As far as an acquisition is concerned, I think there's a couple of key points that need to be considered. Obviously, based on your organization's view of the future and what it is that you're seeking to achieve through an acquisition, understanding the operating context that your organization works within. So, how big is the market? How fast is the market growing? What are the drivers of that growth? What does the competitive environment look like? What does the regulatory environment look like? And is that enabling for an organization of your kind? And then finally, a very clear understanding of a potential target organization. What is that going to bring to you in terms of trying to achieve your objectives? I think the next questions then become whether you internally within your organization have the right capability set to bring in another organization not just from a core operational perspective and integration, but very importantly from a management bandwidth perspective. And then I think the final thing to consider is around cultural alignment of the two organizations. Very often, it's the cultural fit between two companies that can destroy a potential transaction. And we work on transactions on a daily basis, and the culture issue is something that is incredibly difficult to solve for.
Yeah, 100%. And another important one would be financial stability. Both companies should be able to weather post-merger risks. And exactly as Rob mentioned, cultural integration is key. Will both teams maintain their productivity? Will the culture be integrated? And, no deal should be signed without considering these aspects.
So talking about acquisition, what are the pitfalls and what are the results of a bad integration? Obviously, once you've acquired the company, you're either going to go business as is or you're going to integrate the business. How does that work? And what are the results of a bad integration?
So I think one thing that I've observed when especially in corporate transactions is that the acquiring company makes the decision to conduct an acquisition, and they do it for a very clear, defined strategic purpose. And that is the rationale that's used when they go to whoever's providing the capital, whether it's the shareholders or the banks or whoever it is, in order to finance that acquisition. They go through the process, and post-acquisition, the very first thing they do is have a big strategy session to figure out what they now want to do. And that is fundamentally wrong, because they've gone into it with a well-defined strategic rationale already. If you change the strategy post-acquisition, the parameters that you've set for your capital providers is going to completely change. And therefore, no matter how you manage or however you measure it post the transaction, it's never going to align to what you originally said it was going to do. So importantly, from a post-acquisition integration perspective, holding the line and having someone in the room who's very, very clear on what the original strategic purpose was and strategic rationale was is important, because ultimately when the strategy is clear and everybody knows what needs to be done there, then the operational and business integration pieces can then be aligned behind that.
So it sounds quite complex, and obviously people need guidance in this. I was just thinking as you were talking, what does deal strategy do in this scenario? I know about the fact that you do commercial due diligences. Perhaps you want to just expand a bit on that, and what's the role that you play?
So we get involved in the full deal life cycle. So on the pre-deal end of the life cycle, we'll get involved in strategy development, market entry assessments, portfolio reviews, even target screening exercises where we'll help a company identify a short list of potential acquisition opportunities. Then in the actual execution phase of the deal, this is where commercial due diligence comes into play. And this is really about identifying the risks and the opportunities that exist around a very specific target in terms of the commercial operating environment and the business model of that target business and how the business is set up to engage with the operating environment. So if I just very quickly, in terms of business model, I'm talking about the products and services, the distribution and sales channels, the marketing that supports that, as well as the pricing structures and the go-to-market strategy. And it's important to understand how all of that is configured in the context of what that market looks like. And again, it is the size of the market, it's what is driving the growth of the markets, and that's going to be from a consumer perspective, so consumer behaviors. Pricing ties into that, so what is market pricing and benchmarking around that. And so we highlight all the risks and opportunities as it relates to those elements of a very specific transaction. And that's important to consider because maybe the target is performing well, but in the operating context, the outlook for the market is not so good. So you don't want to be going and deploying a large amount of money on an acquisition if that's not right. In the same way, maybe the market's performing really strongly and the business is being successful because it's a case of a rising tide. Maybe the business isn't optimally structured to take advantage of that. it might not scupper the transaction, and it might represent an opportunity for the acquiring company to improve the business model, to really enhance the performance of that business. But that's what we do in the execution phase of a transaction. And then in the post-acquisition phase, as we said, when it comes to that integration piece, we try and hold the line on the original strategic rationale. So we try and create that golden thread from the very starting point of the acquisition all the way through to the integration piece. We shouldn't and don't necessarily have a big role to play in terms of post-acquisition strategy development, unless it's likely to be a standalone business. But if it's a corporate integration, we're in the room to make sure that people remember what the original sense was behind going down that road.
Wise words. Muhsinah, any last thoughts?
Yeah, I think it's important to think beyond the transaction. Acquisition is a strategic growth lever, not a quick fix. Plan for your diligence, evaluate your readiness, and plan for integration.
Great. Well, thank you so much for sharing your wisdom with us. That was really insightful. Business growth always brings complexity and has to be aligned with your growth strategy. Thank you for watching. Please watch out for our next podcast, which will be on the evolution of technology in business. Thank you very much.